14.3 billion euros. That was the amount the European Commission said Apple owed Ireland in unpaid taxes. But Ireland, the country supposedly owed the money, spent 8 years and millions in legal fees, fighting to never collect a single cent. Nobody was paying attention to a letter sent by the Irish Revenue Commissioners on the 29th of January, 1991. Apple was not yet the colossus it would become. The Macintosh was still a niche product. The iPhone did not exist. The internet was barely a concept outside university laboratories. In Cork, on the southern coast of Ireland, Apple operated a modest campus at Holly Hill with a few hundred employees assembling computers for the European market. That campus would eventually grow to 6,000 workers from over 90 nationalities. But in 1991, it was just another foreign manufacturer taking advantage of Ireland's low corporate tax rate. The letter from Irish Revenue that January confirmed a method for calculating taxable profits for 2 Apple subsidiaries. It seemed routine. It was anything but. The 2 companies at the center of this arrangement were Apple Sales International and Apple Operations Europe. Both were incorporated in Ireland. Both conducted real business through Irish branches. But here is the detail that would cost Apple everything. Each company also maintained what the Commission later called a head office. These head offices had no employees. They had no physical premises. They existed only on paper. Under the terms of the 1991 ruling, the vast majority of profits earned by these companies were allocated not to the Irish branches, where the actual work happened, but to these phantom head offices. And under a specific provision of Irish tax law at the time, profits attributed to entities that were not tax resident in Ireland were not subject to tax. The head offices were not tax resident anywhere else either. The profits simply vanished into a legal void. The structure worked like this. Every iPhone sold in France, every MacBook purchased in Germany, every iPad ordered in Spain was contractually invoiced through Apple Sales International in Ireland. The revenue from the entire European Union single market flowed through Cork. But when it came time to calculate how much tax Apple owed on those profits, the 1991 ruling allowed almost everything to be attributed to the head office that existed nowhere. In 2011, Apple Sales International recorded profits of $22 billion. Of that, only around 50 million was considered taxable in Ireland. The company paid less than 10 million euros in corporate tax that year. The effective rate was approximately 0.05%. And somehow, it gets worse. By 2014, the effective rate had fallen to 0.005%. For context, the standard Irish corporate tax rate during this entire period was 12.5%. Every other company operating in Ireland paid that rate. Apple paid a fraction of a fraction of a fraction. This decision seemed small at the time. It wasn't. The 1991 ruling was not a one-off arrangement. It was renewed in 2007 with only minor adjustments. For 23 years, from 1991 until Apple restructured in 2015, this mechanism operated continuously. The scale grew as Apple grew. Between 2004 and 2014, Apple routed 110.8 billion euros in profits through its Irish subsidiaries. The head offices that existed only on paper absorbed almost all of it. The Irish branches, where thousands of real employees performed real work, were allocated a tiny sliver. The tax authorities in Ireland never questioned why the effective rate kept declining. They never asked why a company booking over 100 billion in profits was paying single-digit millions in tax. The arrangement might have continued indefinitely, if not for a hearing room in Washington, D.C. On the 21st of May 2013, the United States Senate Permanent Subcommittee on Investigations convened a public hearing. Senator Carl Levin chaired the session. Apple CEO Tim Cook sat at the witness table. Apple CFO Peter Oppenheimer testified alongside him. The committee had spent months investigating how American multinationals shifted profits offshore. What they found with Apple stunned even the senators. Levin declared that Apple had sought the holy grail of tax avoidance. He described Apple's Irish subsidiaries as ghost companies that existed nowhere for tax purposes. Oppenheimer insisted that Apple complied not only with the laws, but with the spirit of the laws. The senators were unconvinced. The hearing made global headlines. And in Brussels, officials at the European Commission's Directorate General for Competition were watching. The Commission's investigation did not begin with a dawn raid. This was not a cartel case. There were no sealed rooms or forensic imaging teams. Instead, the Commission opened a formal state aid investigation on the 11th of June 2014, under the authority of Commissioner Joaquin Almunia. The question was precise. Had Ireland, by issuing those tax rulings, granted Apple a selective advantage not available to other companies? If so, it constituted illegal state aid under Article 107 of the Treaty on the Functioning of the European Union. The investigation required the Commission to examine the exact mechanism of profit allocation, compare it to what other companies faced under the same Irish tax rules, and determine whether the arrangement corresponded to economic reality. The case team at DG Competition spent over 2 years analyzing documents, financial records, and the internal structure of Apple's Irish operations. By the summer of 2016, the investigation was complete. On the 30th of August 2016, Commissioner Margrethe Vestager stood at the press podium inside the Berlaymont building in Brussels. Behind her, the blue and gold of the European flag. Before her, a room packed with journalists from every major outlet in the world. Her statement was measured and devastating. Member states cannot give tax benefits to selected company. This is illegal under EU state aid rules. The Commission's investigation concluded that Ireland granted illegal tax benefits to Apple, which enabled it to pay substantially less tax than other businesses over many years. In fact, this selective treatment allowed Apple to pay an effective corporate tax rate of 1% on its European profits in 2003, down to 0.005% in 2014. The recovery order was up to 13 billion euros, plus interest. The largest tax recovery in European Union history. That's the kind of number that makes accountants cry. The Commission's decision document ran to 130 pages. Its core finding was surgical. The head offices of Apple Sales International and Apple Operations Europe had neither the employees nor the physical presence necessary to manage the intellectual property licenses that generated the profits. The only activities associated with these head offices were occasional board meetings where directors, many of whom simultaneously worked full-time as executives for Apple Incorporated in Cupertino, approved dividends and administrative matters. The real work, the procurement, the distribution, the logistics, the online sales, the after-sales service, all of it happened in the Irish branches. The profits should have been taxed there. The allocation to the phantom head offices was, in the Commission's words, artificial and without factual or economic justification. What happened next defied logic. Ireland announced it would appeal the decision. The country that had just been told it was owed 13 billion euros by the world's richest corporation chose to spend public money fighting against receiving that windfall. Finance Minister Michael Noonan declared that Ireland did not give favourable tax treatment to Apple and that Ireland does not do deals with taxpayers. He framed the Commission's ruling as an attack on Ireland's corporate tax regime and warned it represented a bridgehead for those who wanted to dismantle the 12.5% rate. Apple also appealed. Tim Cook called the ruling total political crap in an interview with the Irish Independent. He insisted there was no special deal. Ireland and Apple found themselves on the same side of the courtroom, united against the European Commission. The appeals wound through the European court system for years. In July 20, the General Court in Luxembourg delivered a shock. It annulled the Commission's decision entirely, ruling that the Commission had not demonstrated to the requisite legal standard that there was an advantage. Apple and Ireland celebrated. Vestager's landmark case appeared dead. But the Commission was not finished. It appealed to the Court of Justice of the European Union, the highest court in the EU system. The case was assigned to the Grand Chamber, the most senior formation of judges. The legal arguments centered on whether the General Court had applied the wrong legal test, whether it had relied on inadmissible evidence, and whether it had imposed an impossible burden of proof on the Commission. If you're finding this investigation as revealing as I did, consider subscribing. I publish a new case every week. By September 2024, the case had been in litigation for 8 years. On the 10th of September, the Grand Chamber of the Court of Justice delivered its final judgment. It set aside the General Court's ruling. It dismissed the appeals of Ireland and Apple. It confirmed the Commission's original 2016 decision in full. The court found that the General Court had made errors of law. It had compared the functions of the Irish branches to those of Apple Incorporated in Cupertino, rather than to the head offices of the Irish companies themselves. It had accepted evidence that was produced for the first time during court proceedings, not during the administrative investigation. And it had required the Commission to prove a negative, an impossible standard. The operative words of the judgment were unambiguous. The Court of Justice gives final judgment in the matter and confirms the European Commission's 2016 decision. Ireland granted Apple unlawful aid which Ireland is required to recover. There were no further appeals available. The legal road was exhausted. Apple had deposited the funds into an escrow account managed by the National Treasury Management Agency and held by the Bank of New York Mellon back in 2018. Principal was 13.1 billion euros. Interest added another 1.2 billion. The total transfer to the Irish Exchequer in May 2025 came to 14.24 billion euros. Ireland, the country that had spent 8 years and over 10 million euros in legal fees trying to avoid this money, finally received it. And no, I'm not making that up. The irony runs deeper still. Apple's stateless subsidiaries had no employees and no offices, yet they booked over 100 billion euros in profits across a decade. The head offices, whose only documented activities were occasional board meetings about dividends, were attributed virtually all the revenue from Apple product sales across Europe, the Middle East, Africa, and India. Meanwhile, 6,000 real employees in Cork performed the actual work of procurement, manufacturing, distribution, and customer support. They generated the value. The phantom entities captured the profit. The structure was legal under Irish law until 2014, when Ireland closed the loophole. But Apple had already restructured. In 2015, the company shifted its intellectual property into Ireland under a new regime called Capital Allowances for Intangible Assets, sometimes called the Green Jersey. The move was so large, it caused Irish GDP to spike by 34.4% in a single year, an event economists dubbed leprechaun economics. The case sent shockwaves far beyond Ireland. The Commission pursued similar state aid investigations against Amazon in Luxembourg, Fiat in Luxembourg, and Starbucks in the Netherlands. The results were mixed. Courts overturned several of those decisions, but the Apple case survived every legal challenge and established a precedent. State aid rules could be used to police tax competition between EU member states. National sovereignty over tax policy was not absolute. If a country granted a selective advantage to one company that distorted competition in the single market, Brussels had the authority to intervene. The global response was equally significant. The OECD and G20 nations accelerated work on a global minimum corporate tax. Pillar 2 of the International Tax Reform Framework established a 15% minimum effective rate for large multinationals, directly addressing the kind of structure Apple had exploited. Ireland, which had long resisted any harmonization of corporate tax rates, signed on. The rules took effect in 2024 and 25. The era of 0.005% was over. Not because companies suddenly developed a conscience, but because the legal architecture that permitted it had been dismantled. Vestager, reflecting on the final court victory, said it was a win that made her cry, because it is very important to show European taxpayers that once in a while, tax justice can be done. Cook never retracted his characterization of the ruling as political crap. Noonan left office in 2017. The 13 billion sat in escrow for 7 years, its value fluctuating with interest rates, before Ireland finally accepted it. The country is now debating how to spend the windfall. Options include paying down national debt, funding infrastructure in housing and transport, and investing in sovereign wealth funds. The money that Ireland fought so hard to reject will reshape its public finances for a generation. 1 clause. Buried in a letter dated the 29th of January 1991, agreed between Apple's tax advisor and the Irish Revenue Commissioners. That clause allowed profits to flow to an office that did not exist, in a jurisdiction that did not apply, at a tax rate that approached zero. It took 25 years for anyone to challenge it. It took another 8 years of litigation to confirm it was illegal. The total cost to Apple was 14.3 billion euros. The total cost to European taxpayers, who subsidized Apple's competitive advantage for over a decade, is incalculable. The next case I am covering makes this one look like a parking ticket. 6 truck manufacturers, 14 years of price fixing. 3.8 billion euros in fines. The largest cartel penalty in European history.